Hi there, I'm Chris. If you don't know me yet, don't worry. I'm a dividend growth investor living in Europe, and I recently started this channel to share my knowledge that I've been building up so far because I started investing in dividend growth stocks since late 2014. There's a lot of information out there, mostly from a US perspective, and I hope that I can contribute a little bit by giving also more and more of a European perspective. However, before we start, if you'd like to learn more about dividend growth investing from a European perspective, then start now by liking this video and subscribing to this channel. This is an easy way to stay informed on what's upcoming, and it gives me a lot of pleasure to see some audience. Having said that, let's start with today's video. To get to know more about the stock and whether it's worth investing, I always first look into the company. And one of the first and best things to always start with for me is the annual report or their company website. And typically you can go to the investor relations of any corporate company, and in this case also for Unilever. Now, what I found out is that their vision is to make a sustainable living commonplace. I don't think this is something recently. I don't think personally there's a lot of management language or bullshit in this, because I've seen already since the last 10 years that they're really caring about their environment. And also you can typically see that when you do a little bit of YouTubing on their CEOs, you will find that this is a common narrative all the time when they are doing public events. Now, Unilever is a holding. It has many brands, and effectively, this is a company that's, for me, excelling in marketing. Now, if you look at other companies in their industry, we've got Nestle and Procter and Gamble, which I would say have a bigger market share than Unilever itself. But on this global level, these are all three truly great companies with a really long track record in history. Now, if we look at Unilever, what I found out is that they are really growing in the emerging markets. It's for them really a big bet. And later on in the data, I will show you a little bit how that's looking like. At the same time, they're really looking into sustainability. For me, that's something great and also really something that resonates well with me. They're one of the front runners when you think about taking their responsibility as such a large company and, for instance, reducing waste and being a better global citizen. At the same time, the company has been recently really starting to do many small acquisitions, and I think most noticeable that we know of or that you might be familiar with is the Dollar Shave Club. Now, if we then look at a shareholder return, it's besides being really good for the stakeholders when it comes from sustainability point of view, it's also a great company when it comes to shareholder return. And in 2018, they just bought back 6 billion of own shares, which was an equivalent of 4% of their total outstanding shares. So just by not doing anything, no any growth in revenue, they were already able to increase the earnings per share with 4%, which typically should be reflected in the share price. At the same time, their dividend policy is to pay an attractive, sustainable, and growing dividend. And I think this is also proven with their long track history already. Let's look then into the quality of the stock. Now, what I always do is I look first at the financial strength. Is this company actually in a good shape? Think about your household. Can you pay your debt? Can you pay your bills? And then in the end of the day, do you still have some money left? Now, when we look at the debt equity, it actually looks quite high at the moment. And for me, there's a strong correlation. It's even visible from the data, and that really equates to the share buyback. In this low interest environment, it's really attractive for companies to issue a lot of bonds or issue a lot of debt and use that for buying back shares, because it's simple. If you pay 1 or 2% on debt and you would pay an 8% rate on return expectation to a shareholder, then it's just a really great value adding activity for the existing shareholders to just buy back the shares, because you keep more money in the pocket in the end, and all that money will be then distributed among a lower share of investors. So I'm not worried about this amount of debt. It has, as you can see, also a really great interest coverage. They can easily pay the debt. However, I do hope that in the nearby future that they will also bring down a little bit the debt again, so that it becomes at least lower than one. I think that's a healthy balance for a company like Unilever to be in. But yeah, I fully understand that they took the opportunity to raise a little bit of debt now with these low interest rates to bring back more value to the shareholder. Now, if we then look at the EPS growth and cash flow growth, two metrics that are really important for me. So EPS is the earnings per share. This is something that we want to see growing over time. Because this is really what a company is about for me, like a capitalistic company like Unilever, is that they just grow earnings over time and return a part of those earnings back to the shareholders, in my case, preferably in dividends. And at the same time, I want to see this also for the cash flow. Now, and that's what these two graphs clearly show, that there is a continuous uptrend in earnings growth and cash flow growth, although you can see that the cash flow grows a little bit more bumpy. For me, the cash flow figures are more realistic typically and something that I really look into. In this case, you can also see in the earnings per shares that there's a really high bump in 2018, and this has been due to a one-time event, and that was the sale of their spread business. Their underlying EPS as reported was €2.57, and that will be more directly on top of the current trend line. Now, how does it look from a credit rating? I think they look really great. Moody's graded them not long ago with A1 rating, and as you can see here, this really well investment grade, upper medium grade. So also a company like Moody's or rating agency like Moody's also really thinks that there's a lot of, I said, good balance sheet, good financial management, which gives them a lot of confidence to give them this rating. So from a financial strength point of view, for me, it really looks good. However, I would like to see the debt equity ratio over time to go a little bit down again. In 2019, they didn't announce any further share buybacks. I haven't heard anything so far from 2020, so my expectation is that this rating will go a little bit down again in the upcoming annual report. Now, next, what I typically look into is the management quality. Does the management show strong integrity? Well, how I typically look into this is, and this is just one way of measuring it. You can look at many ways of measuring it, but the one measure that I look at is whether there have been many violations reported, because this shows me really like what kind of people are these. Are they often in court or not? And I compared a little bit to also Procter and Gamble and Nestle, and I could really see that Nestle is a top violator, so to say. But if you look at Unilever, it sounds still quite high, this penalty of 4.5 million. I've looked it up. This is due to a case somewhere in America where there was environmental waste with the water resources that they were doing. They were fined for 1 million, and Unilever also decided to add 3.5 million additional to clean up the environment there. All in all, I don't think this is too bad, and I'm happy that Unilever took their accountability there and also helps with restoring the environment. I've been looking also into the past acquisitions. I referred to it already a little bit. Many small size acquisitions have been made lately. It's not really visible in the data to see whether this leads into a high return on investment. Management is also not really transparent in that, and it's also, of course, I guess, a little bit difficult to do that with all these small acquisitions. But I like it that they are really looking beyond how they were doing business traditionally. For instance, Dollar Shave Club is really having a subscription-based business model. And with the marketing power of Unilever, I really think that Unilever can help such brands grow and turn them into the next billion-dollar brands. And I like it that they're doing this because I believe that the new way of convincing customers to buy your product is to be really mindful about the environment and have a stakeholder management approach. and Dollar Shave Club and some of the other recent acquisitions really play onto those trends. Another measure that I typically look into is like how was the company performing during the last recession. And in this case, Unilever did quite well. Dividend was growing, no impact there, which is quite important for me because I want to see growing dividends also in bad times. But at the same time, also the EPS decline was really limited. This was the greatest recession after the Great Depression. Many companies got really, lost half of their earnings within few months. Unilever, 9%. And for me, it's a little bit of a no-brainer. It's a consumer staple. They provide our basic needs effectively. And yeah, 9% EPS decline, not bad, and really allowed them to cover the dividend nicely. The last one I look at might be a matrix or ratio that you're not so familiar with. This is the capital expenditures divided by the free cash flow. Something that I look into is like how much are they really investing again back into their business. And I would like to see that around 30%, let's say, not more than 30% as well, because this is for me a healthy ratio for a company really to invest, but at the same time keep some money at hand for redistributing it back to the shareholders. So for me, this is a really perfect ratio, almost in the sweet spot. And yeah, so my summary of this one: quality of the stock and quality of the management, very well. And with the recent new introduction of the new CEO, I think he still has a little bit of time to prove himself. But what I have seen so far is that he's pushing it forward as what his predecessor already set up. So I'm pretty happy with that. The next thing that I typically look in is the dividend quality of the company. In the end, I'm a dividend growth investor. There are a few metrics that I look at. The first one is the current yield more than the S&P 500. It's for me kind of a benchmark because otherwise I could rather put it in an index fund. And in this case, it looks pretty good for Unilever. It's 3%. I wouldn't say it is historically high. It's been on 3.5%, 4% in the past. But looking at where the market levels are now, they are record highs. I don't think this is a bad yield. When we look at the dividend growth, well, this is really where it becomes, where it's effectively a dividend aristocrat, but then in Europe, because it has been growing and not cutting its dividend since 1966, which is really one of the few companies in Europe. If we look at the dividend growth rate, over the last 5 years, it's approximately 6.6%, which is pretty good, I would say. It's not like wow, but it's pretty good. If you add this with a 3-4% general EPS growth, then you're easily making 10% per year, which I think is pretty good, and at least that's something that I'm really satisfied with. Payout ratio, EPS, I prefer that to be around not more than 60% for a company like Unilever, and you can say that's really around the boundary of it, which means that going forward, if they don't want to get into paying out too much of their EPS or free cash flow, that the next raises will typically in lockstep with the EPS growth or the cash flow growth, which is historically also around the 6-7%. So I think it's quite stable, and I've got similar expectations going forward. For me, this also means that the dividend quality is pretty good, something that we can trust on, I think. If we will do it for the next 50 years on this one, I'll buy it, no problem. Now, that was around the quality of the stock, but if we now look at the stock price, where is it? A little bit just from a historical point of view. You can see here is that it has been steadily growing, not as the 30% that you see other stocks easily doing over the last 1-2 years. No, it's been steadily growing. But what I also wanted to point you at is that lately you might have heard in the news about Unilever that they suddenly dropped 10% on a day. Well, this is where you can see that probably the stock was priced for perfection, because really what the CEO said there is that they are giving a revenue growth warning. Their expectation was to grow between 3 to 5% in revenue. He announced just recently that they will be just below the bottom of that expectation. So now it's probably between 1 and 3%, somewhere there. I'm fine. Headwinds were explained. Growth in Asia is a little bit not as per expectation. Some costs are higher. These come with ebb and flows, and I'm okay with it. With 10% down, because actually I get just more dividend for the buck. Now, valuation. So what we've done just is we looked at the story of the stock, we looked at the stock, the quality of the company, the dividend quality. We had a little bit of a look at what the stock price is doing, and the current price, I don't know exactly, it moved up a little bit today, but it's around 51, 52 euro. So if we look at some simple valuation metrics, then you can see that the PEG ratio is on 3.5. That's way too high for me. I prefer it really to be between 1 and 2, which tells me just that the growth expectations are just low going forward. This might have to do with the recent warning from the CEO. But this is one of the metrics. If we then look also at the future earnings, and the price for future earnings, it's around 18, 19, which is for me pretty fair. I don't like paying more than 20, taking next year's earnings into account, and this is pretty fine. The price to cash flow is for me still a little bit on the high end. Like I just mentioned, I also prefer it from a cash flow point of view to stick to maximum 20. So if I would just look at these from a valuation point of view, I still find the price a little bit on the high end and would probably not buy it. But I also did my own cash flow analysis. Based on that, the calculations that I've done is that based on discounted cash flow, the value of the company is around 45 euros. If you look at it from that point of view, I also did the dividend discount model. It's around 55 euros. And I also looked at the Chowder rule. Chowder rule is a famous rule coming from Seeking Alpha. I will post a link in here below so that you can have a look into it. And that theory is that you should have around, for a company like Unilever, you should have around a number of 12, which means EPS growth or dividend growth plus the existing dividend should be around 12. Now, in this case, we know that it was around 6.7 for the dividend growth. The actual dividend was 3, so hence the 9.7. So does this make the company now for me worth buying? So having said that, in my opinion, it is really, really expensive at the moment. Although the recent 10% drop in stock price is for me still too expensive for a company, it has no margin of safety. For me, it's still priced to perfection. So if I take the dividend discount model and my own cash flow calculation together, I come to a fair value estimate of 50 euros, including a margin of safety, because I might be wrong. I would probably buy it at 45 euros. At that time, you would have a dividend yield of 3.6%, which is much better for me for a company like Unilever. So for now, do I consider buying? Nope, I will not consider buying now. I'll be waiting for a drop. Maybe in January 2020 we'll get a nice 10 to 15% drop in the overall market. And if Unilever would decide to drop that much as well, then I will be a happy buyer and extend my portfolio into Unilever, because I'm really eager to add more to this company. For now, I find it a bit too pricey, and in mindset, I'm conservative, so I don't feel it's worth buying. I can wait. Well, thank you. I really hope that you like this video. If you have any questions, please contact me on Twitter, European_DGI, or just email me directly at europeandgi@gmail.com. And if you would like to be informed about more upcoming videos, then please hit the like button or subscribe to my channel, and let's stay in touch. Cheers! This channel to share my knowledge that I've been building up so far, because I started investing in dividend growth stocks since late 2014. There's a lot of information out there, mostly from a US perspective, and I hope that I can contribute a little bit by giving also more and more of a European perspective. However, before we start, if you'd like to learn more about dividend growth investing from a European perspective, then start now by liking this video and subscribing to this channel. This is an easy way to stay informed on what's upcoming, and it gives me a lot of pleasure to see some audience. Having said that, let's start with today's video. Hi there, I'm Chris. If you don't know me yet, don't worry. I'm a dividend growth investor living in Europe, and I recently started this channel to share my knowledge that I've been building up so far because I started investing in dividend growth stocks since late 2014. There's a lot of information out there, mostly from a US perspective, and I hope that I can contribute a little bit by giving also more and more of a European perspective. However, before we start, if you'd like to learn more about dividend growth investing from a European perspective, then start now by liking this video and subscribing to this channel. This is an easy way to stay informed on what's upcoming, and it gives me a lot of pleasure to see some audience. Having said that, let's start with today's video.